Imagine waking up, checking your stock trading app, and realizing a stock you were watching jumped 12% overnight, without warning. No major news. No breaking headlines. Just a price gap that occurred while you were asleep. For some traders, that's a missed opportunity. For others, that's how they make their daily profit. What if these sudden gaps weren't just random movements, but predictable trading patterns used by smart investors to ride momentum and secure fast wins? If you've ever wondered how some traders consistently profit even when the market seems unpredictable, it's time you learn the strategy behind gap trading. This guide will show you how to spot, understand, and profit from these gaps, even if you're a complete beginner. What are gaps in the stock market? In the stock market, a gap occurs when a stock's price opens significantly higher or lower than its closing price the previous day, creating a visible gap on the price chart. For example, if stock A closes at $50 on Tuesday and opens at $55 on Wednesday, there's a gap up of $5. If it opens at $45 instead, there's a gap down of $5. Gaps represent sharp changes in investor sentiment and are often driven by earnings reports, news events, upgrades or downgrades, economic data releases. Types of gaps you must know. There are 4 main types of gaps every trader should understand. 1. Common gaps. These are small, everyday gaps that occur in quiet markets. They typically get filled quickly and are not trade-worthy. 2. Breakaway gaps. These happen when price breaks out of a consolidation zone or chart pattern. They signal strong momentum and are often the start of a new trend. Example, a stock trading sideways at $20 to $22 suddenly opens at $25 and starts climbing. This is a breakaway gap. 3. Runaway, or continuation, gaps. These occur in the middle of an existing trend. They show strong buying or selling interest and often lead to continued price movement in the same direction. Tip: these are great for trend-following strategies. 4. Exhaustion gaps. These appear at the end of a strong trend, right before it reverses. Often caused by panic buying or selling, they're usually followed by a reversal. These are high risk if not identified correctly. Trade with caution. Why gaps matter for traders? Stock market gaps are windows of opportunity. They reveal key moments when news hits after market hours, investor sentiment shifts suddenly, volume spikes push prices dramatically. Smart traders use gap trading strategies to enter positions early with momentum, ride trend continuations, catch reversals before they unfold. How to profit from gap trading, a step-by-step beginner's guide. Let's walk through exactly how to trade gaps using a simple and repeatable process. Step 1. Choose the right stocks. Focus on highly liquid stocks, like tech giants or popular mid-caps. Stocks that trade with volume, over 500K per day. Stocks that often react to news and earnings. Step 2. Use pre-market scanners. Before the market opens, use tools like TradingView Pre-Market, Finvi Screener, Yahoo Finance, Benzinga Pro. Look for stocks showing big pre-market moves, 2% plus, high volume, strong catalysts, news, earnings, analyst upgrades. Keyword: how to find pre-market gappers. Step 3. Identify the type of gap. Ask yourself, is this a breakaway from a long consolidation? Is it a continuation in an existing uptrend? Is this gap happening after an extended move? Could be exhaustion. Label the gap before you trade. This determines whether you follow or fade the move. Step 4. Analyze the volume. Volume is your confirmation tool. A gap with high volume often signals institutional buying or selling. Increased retail trader interest. A potential new trend. Low volume gaps may get filled quickly and are risky. Step 5. Plan your entry. There are 2 common ways to trade gaps. 1. Gap and go strategy. Ideal for gap ups with strong volume and news. Enter as soon as the stock breaks the high of the opening candle. Use a tight stop loss just below the low of that candle. Ride the momentum upward. 2. Gap fill strategy. This is contrarian, you bet the gap will get filled. Look for low volume gaps, no news, or exhaustion gaps. Wait for the price to show rejection signals. Enter short, for gap ups, or long, for gap downs. Target the previous day's close. Step 6. Set stop loss and target. Always protect your capital. For gap and go, stop loss equals just below breakout candle. For gap fill, stop loss equals just above the gap high or low. Target 2x, 3x your risk for a favorable risk-reward ratio. Step 7. Track, log, and improve. Use a gap trading journal to track. Type of gap. Entry or exit points. Volume. News catalyst. Outcome. Over time, patterns will emerge, helping you refine your strategy. Common mistakes new gap traders make. Avoid these pitfalls. Chasing the gap without confirmation. Wait for volume and price action to support the move. Ignoring the market context. A bullish gap in a bearish market can quickly reverse. Trading gaps with low volume. This is a sign of weak conviction, avoid. Using big position sizes early on. Start small and scale as your strategy proves profitable. Pro tips for gap trading success. 1. Stick to liquid stocks. Thinly traded stocks can gap and crash, too risky. 2. Practice with simulators. Use demo accounts on Thinkorswim, TradingView, or Webull. 3. Combine with technical indicators. Use moving averages, RSI, or MACD for extra confirmation. 4. Learn from the pros. Follow traders on YouTube or Twitter who specialize in pre-market gap trading. Real example, Tesla gap and go strategy. Previous close, $250. Pre-market gap up, opens at $262. News, record-breaking EV deliveries. Volume, high. Entry, break of $263 on strong volume. Exit, $275 after 3 hours. Profit, $12 per share. Tools you can use for gap trading. Here are the best gap trading tools. TradingView, charting and gap detection. Finviz stock screener with gap filters. Benzinga Pro real-time news plus gap alerts. Webull's pre-market gap scanner. Thinkorswim simulation plus live trading. Should you trade every gap? No, not every gap is worth trading. Follow this checklist. Is there a catalyst? Is volume strong? Does it match a known gap pattern? Is the overall market trend in your favor? If the answer is yes, go for it. If not, sit it out. Patience is a gap trader's secret weapon. Final thoughts: why gap trading works. Gap trading works because it taps into emotion-driven market behavior. Whether it's panic buying, FOMO, or news reactions, gaps show where momentum lives. When done right, gap trading allows you to profit quickly, minimize holding risk, catch trend beginnings or reversals. And the best part? You don't need advanced algorithms or Wall Street experience to do it. Conclusion: start small, learn fast, grow confident. Gap trading is one of the fastest ways for beginners to get results in the market when done with discipline and knowledge. Start by practicing with small trades, focusing on high-volume stocks, journaling every trade, avoiding emotional decisions. And remember, consistency beats luck. Ready to try gap trading? If you're serious about learning how to profit from market gaps like a pro, start tracking pre-market movers today. The next big opportunity could be just one gap away. And that's the wrap. If you found this video helpful, kindly give it a like, subscribe and share to your friends. Thanks for watching and see you in the next video.